Hey guys, Steve Zelnardo here with Remax West, Zelnardo Associates, and today's topic is inflation. So I'm just going to read an article I read this morning regarding inflation. The article reads, the Consumer Price Index gained 7% year over year last month. So basically in December, it was 7% year over year inflation growth, which is massive. The pace is the strongest inflation since 1982 and marks a slight acceleration from the 6.8% year over year seen in November. So it's obviously an upward trend, as they're saying. And I'll read on. The report reveals inflation worsened slightly through the last month of 2021 as Omicron spread across the country and supply chains healed. Inflation became the biggest issue clouding the U.S. recovery as consumers finally returning to some normal activity crash into the fastest price growth in decades. And that's meaning when you go to the stores, everything's a lot more expensive. If you're pumping gas, if you're buying food, if you're doing anything related to consumer purchasing, you'll see the price differences when you do pay for them. I'll read on the article here. So it says the Federal Reserve shifts its focus to fighting the inflation surge. The central bank announced in December it would double the pace at which it shrinks the emergency asset purchases. So basically the quantitative easing, they're gonna pull that down. I think that was supposed to be 15 to 20 billion down from the 120 that they were spending per month, I would imagine. So they're gonna drop it down to 15 to 20 billion, but I think they're gonna even go further than that because that hasn't done anything to curb inflation. It says so teeing the program up in March, and basically shutting down the program in March. The faster pullback sets the stage for multiple interest rate hikes in 2022. And it says the federal chair, Jerome Powell, said Tuesday he's willing to accelerate the rate hike timeline if inflation doesn't fade as anticipated. So he's meeting today to discuss this. This is a big day. If we have to raise it, this is him in quotations, if we have to raise interest rates more over time, then we will, Powell said. To get a long expansion, we're going to need price stability in a way. High inflation is a severe threat to the achievement of maximum employment and achieving the long expansion that can give us that. So basically what they're saying there is obviously inflation super high. It's as high as it's ever been since 1982, which I was born in 81. I remember it was sort of bad times even for my parents with mortgages and stuff. It was a little bit great times even here in Canada. What they're saying there is if the interest rate, the inflation is a direct threat to the maximum expansion job employment. And this is going to tee off into this article here. Just remember this. It said high inflation is a severe threat to the achievement of maximum employment. And so basically that's currently right now. We have high inflation and low employment. And it's not because there's not jobs available, it's people are not going back to work. And I'll just read a little bit of this article too. It says basically there's a market indicator that's called the Phillips curve. It's one of the economics' most widely accepted concepts. Basically, this tells you when to increase interest rates to cool inflation and when to decrease them to fuel back the market. So the rule goes like this. Unemployment and inflation have an inverse relationship, meaning inflation is low when unemployment is high and vice versa. So when employment is high, inflation is high. It's meaning the economy is in full rotation. It's going, right? It's in full flat out, as I say on the race. So this usually helps the central bank determine when to slash rates to stimulate the economy and when to hike them to cool inflation, which is basically what I explained. So a little bit different in today's market because they call this the Corona recession, which threw a wrench in the relationship that this market indicator usually would be a great way to kind of curve this inflation. So what's happening right now is labor force participation is far from recovered as millions of Americans remain on the job market sideline. Yet inflation is running at its fastest rate in nearly 4 decades. The situation has complicated the Fed's mission and forced it to temporarily prioritize one goal over the other. So what the Feds are doing is they got to prioritize over one. They have to, usually it's like what the rule was saying is that when inflation is low, unemployment is high. So what they'll do is they'll create inflation to create employment, but now they're going to have to do one or the other. So obviously what they're going to do now is curtail inflation, because inflation would have, in a normal year, would have created more jobs, but it's not. It's actually taken about 3.5 million jobs or haven't come back online since COVID. And these are probably more minimum wage jobs, stuff like this, bartenders, restaurant, people that work at restaurants and stuff like that. I get jobs like this. I would imagine major employment have gone back. So what's happening, I know in the States there's rules where if you work less than 18 hours, you can still claim that wage and still claim the subsidy from the government. So a lot of part-time workers or workers working in restaurants and jobs like this were making more money than ever. So they never really came back online, which is obviously affecting this. So what these guys want to do now now is basically kill inflation naturally, which they have to do, and hopefully that brings people back to the market for employment, because they are quitting or stopping the stimulus package and the quantitative easing, which is naturally going to get everyone back to work. So that's the goal. It's definitely a complicated matter, and I'm hoping they get this right, because we need this inflation to stop and also housing prices to slow down. So we will find out today, and we'll report next month. That's it, guys. If you like the video, you can always reach out, or please like, share, and subscribe, and we'll get you on the next one. Thanks.